Good morning, everyone. Welcome to the Trading Market Technicals Morning Call video for Wednesday, April the 10th. We did get that push higher, as mentioned in yesterday's video. However, we did not take out the all-time highs in the S&P. Dow made new highs, actually. Dow up 59, NASDAQ up 16.5, gold up 11 due to a weak dollar, and then we have the S&P up 5.5. As much as this euphoria it is, it's very, very quiet during the day. You have about an hour to an hour and a half worth of trading, and then you have market just slowly grinding higher, no volume. I mentioned yesterday also about the how the indexes are moving higher. Really, the S&P and the Dow, that's the only thing that is moving higher. Stocks are not moving higher. There's a certain selective few of stocks that are moving. We do have a rotation, that money coming out of certain sectors and going fueling a rally in certain other sectors. But unless you're an indexer trading indexes, you must be having a ball. Other than that, a lot of stocks aren't really moving as well as you would expect when you see the Dow and the S&P. Now, we also have, and I made comments on this the last couple of weeks, we've had our followers, S&P and the Dow, pushing to new all-time highs, where we have the Russell and we have the transports. They're not, and that's you have market divergence, and that's what I'm worried about. So if you're a bull, that's something to be worried about. Other than that, now that could change. That could change rapidly today. It could change tomorrow, and they could reverse course and break out and start making new highs again, and then everything's back in sync. But when you see that intermarket divergence that you see during the day and on daily charts, you have to be cautious, and especially with these extreme levels and people and retail buying the market up at these levels, expecting a 16 and a quarter, 1650, even 1700. I'm hearing from the pundits within a matter of months. You have to be cautious here. I've been cautious since the beginning of January, and I remain cautious. I don't like when I see things that are not in sync with everything. Not getting a pullback, 1 or 2 day pullback, and then the markets just break higher again is not a real healthy market to me anyway, when you like to see a stair step back and pull. Now we don't get what we like, right? So we want to just trade accordingly, and day trading to me is the best alternative. And sometimes it is slow, but when you have markets that are this crazy, so to speak, I like to take a step back and reduce my exposure until the markets really could correct, and then get back in sync with one another. Okay, so what I wanted to show you is yesterday I mentioned to you that we did have that our stocks above our 50-day moving average have not moved that much, and I showed that to you yesterday, and I want to just bring that up to you again as we have the stocks rolling back down. As you can see here, we're making lower highs, and S&P is making new highs, and you can see here we did tick higher, right, up 240, but that's about it. That's not much at all, 3.5%. When you have stocks that are breaking out, making all-time highs, well, the indexes rather, excuse me. So this is what I wanted to show you. This is just, like I said, you want to use caution. Again, if you're day trading, that's great. But if you're holding positions, I just want to bring that to your attention. So now let's go into the charts and let's take a look at what we have here. We have the spiders, which is our proxy to the S&P, obviously, and we can see here that we have roll. We kind of unwounded our overbought reading on our stochastics, a little bit on our MACD. We did get a little bit of better volume from yesterday, so that's impressive, and we're back above the upper sideways consolidation channel here. So I'd like to see I'd like to still have this market take out the all-time highs and then run up real hard, and either the next day open up and then down, or we run up real hard and then really sell off into the close. That would entice me to say we have a tradable top. Until then, I'm not looking to get short. I do think today's another up day, unless obviously something comes out, anything that's news-driven or a geopolitical event happens. But I do see us continuing to grind higher for today. So my call today would be the same, would be looking to buy dips into this market. If you're indexing, like you're playing spiders or SDS or anything like that, or any ETF, I'd be looking to buy dips as long as the markets are grinding higher. Now, we did get a little bit of pullback in the market early in the morning, and then we kind of rallied into, we paused. we caught a double bottom, and then we rallied into the close. So same thing could happen this morning. But take a look at the Russell. This is what I want to show you. We saw the S&P. The Russell has not done so. We haven't taken out anywhere near our sideways channel like we did in the S&P. We've actually closed lower yesterday. So until this happens, until this starts to really break down, now there could be, it could be okay. Yesterday was just a fluke, if you want to call it that. But I think not. I think that money's rotating out of the Russell and into certain sectors here, probably for some protection of assets, but nonetheless, you really want to keep an eye on the Russell and the transports. If they start breaking down harder, that's not going to go unnoticed. Take a look at the Spider 60-minute. As you can see here, we broke down, we rallied, we held that 153.65. So that's going to be a pretty major pivot support area once we start to roll back down again. So make sure we keep that in mind. 153.65. I have that here. And then we took out the spot, and then we rolled back down again into R1 support. So let's just watch the spiders closely. Again, I think the spiders and the Dow seems to be ripping on their own. They're on their way up, and nobody cares about what's going on with anything else, which is not really a good way if you're at least position trading yourself, or you're swing trading. You want to be real careful with that. Okay, so now we have our 30-minute chart. And as you can see here, we had a 30-minute dip lower, 30 minutes, and we made a higher low off the low, and then we rallied it into the close. We rallied into the close with the last hour of trickling lower. But again, not much here, guys. We're still within this channel range. Take a look at the transports. The transports here, same thing. Now, this is another one of our leaders here. Okay, when the transports rally, usually takes everything else up. They have not done so. As you can see here, we had a red bar, and we back tested this long-term trend line from November, and now we have a red bar. Let's see if we get a little follow through. Keep an eye on yesterday's low in the Russell and yesterday's low in the transports, and see if this can pull the market down with it, the Dow and the S&P. As of right now, we're not looking to short anything. We're looking to buy dips again for the morning session, at least the start of the morning, because we're not looking to counter trend. We want to stick with the trend unless you have relative weakness. If you're looking to trade something that has relative weakness to the market, that's totally acceptable. Okay. XLF really didn't do much yesterday, as you can see here. Again, a real big sector to follow. At least if you're not trading the banks, you might want to at least look at them. They give you good clues intraday as well. Okay, nothing really going on here. We're still in this big bearish rising wedge. That only is bearish when we break and close below the lower trend line. Take a look at our diamonds. Now, this is the proxy to the Dow. Again, made all-time highs again yesterday, and this thing is just totally on fire. There's not enough money coming into it. There's too much money going into it, excuse me. So we have the Dow up here at these areas, and I'm looking for, we have to see really when the Dow starts to slow down, and the Dow and the S&P generally isn't our leaders, but that's what's going on right now in the markets, and that's a little nerve-wracking to me anyway if I was holding any positions overnight. Okay, take a look at the Apple, and I've been mentioning Apple here for quite some time. One thing you have to understand is that Apple here is clearly in a downtrend, and to me is only a trading stock. I've been saying that for weeks and months and months. We do have a double bottom here, but if we break 420, you'll see 400 relatively quick. And remember, options expiration is next week, so you might want to keep that in mind. But we're holding here, but there's no movement. At least if we were bouncing up and down here, testing the 420, backing off, testing the 440 again, I'd like to see that with a little bit of volume coming in. That means that it's trying to break out of that 440. But when you have little spinning tops here in these candlesticks, I mean, there's no interest. And when there's no interest and the buyers are gone at 420, you're just going to have a quick dip down to the 400. So use caution if you're looking to get long Apple here. I would not, for the day, that's one thing, but be careful if you're looking to start building a position. I think you could probably, well, if it goes to 400, it's going to break 4, and you can start buying a position in the high to mid threes. All right, SMHs did a little bit better. That's a little bit better what you want to see here. I mentioned yesterday head and shoulders, left shoulder, head, right shoulder, back testing this slanted neckline right up in here. Now we're back in the neckline. We don't want to get too far past yesterday's high, so we want to see a reversal start to take shape and then start to break down again. And if this does break down, it just adds to the bearish case, okay, that this market should not be rallying this high. But again, if you're a longer term investor, you're invested in mutual funds, you're having a ball, hats off, that's fantastic. But you always want to use caution. I always want to point out what I see. That's part of what these videos are for a little bit of everybody, for day traders, swing traders, long-term investors as well. Okay, and lastly is the Qs, guys. Qs touched it right to our trend line, backed off. We had a nice 3-day run here, Friday, Monday, and Tuesday. Now let's see what happens. We're coming into midweek. Let's see what happens here. Last night I wanted to tell you, China did post an unexpected trade deficit for March on a surge in imports. So that kind of fueled a lot of the resource stocks, BH Billiton and stuff like that. A lot of these resource companies coming out of Australia, New Zealand, and stuff like that. But I think that, again, you have to be cautious here. I would instill totally a reduction of risk, at least right now. But I would like to see this market pull back. And the reason why I say that is because it'd be healthy for the market to pull back, and then we can really get involved with some conviction here. All right, guys, that's really about it. Let's see what happens today. We're up a little bit in the S&P minis, but I do see right now the call would be buy the dips again, or short relative weakness if you're looking for a short play. Have a great day. Keep your stops in place, and we'll see you tomorrow. Take care, everybody.